having me. It's really a pleasure to be here. And you can see this time I didn't bring a tie, so the Swiss National Bank is a learning institution. So what I intend to do is, sometimes I get the question, what happens with stablecoins if central banks start issuing CBDC? So a little bit differently framed, can stablecoins and CBDC coexist? And let me give you the answer right up front. It's a resounding yes, but. And let me now talk a little bit about the yes and the two buts. So why can they coexist? So the coexistence of privately issued money and state money is already a reality today. Actually, it's the norm. It's not something that is unusual. And what I show here, very simple, is that you have the state money issued by the central bank in blue, which are banknotes, and also deposits for certain regulated financial institutions. And then you have what is in green, you have privately issued money, money issued by private companies, commercial banks, issuing deposits, and that's what you usually pay with. So you have these two possibilities to make payments. You have this very beautiful banknote from the Swiss National Bank, the other ultrasound money, and then you have the opportunity to pay with your commercial bank account. And so this is the first part. Why can those two coexist? Simply because they offer different services. They offer different applications, different services. So if you want to pay offline and pay fully anonymous, the only game in town still is the banknote. If you want to have all the digital possibilities, then you pay with your commercial bank deposit. So the first lesson would be stablecoins and CBDC can coexist. So legally, there's nothing that speaks against it. That is how the financial system and the monetary system works already today. You have privately issued money, you have state money, but in order for customers to actually hold both, you need to offer different services. So what's going on right now is, of course, that a lot of tokenization, at least discussions or proposals are going on. One simple one that we also do at the Swiss National Bank is just tokenize basically the deposits that we offer to the financial institutions, and that would be what is called a wholesale CBDC. We have been experimenting with that at the Swiss National Bank in our project Helvetia together with SDX. So the only difference there would be that instead of offering these financial institutions a deposit at the Swiss National Bank, we offer that in token form on a blockchain or on a DLT. And the banks, the Bank A, Bank B, they use that just like they use our accounts to settle payments among themselves. So we just tokenize that. That's relatively simple. The other discussion, of course, going on among central banks is to tokenize basically banknotes, and that would be something that would be usable for the population in general. And central banks are much more reluctant to go into this field because here you would have clear competition now to commercial bank deposits. But again, I mean, basically what the difference would be, commercial bank deposits are used in a certain way. They are not usable on in this form on a blockchain. Retail CBDC would. Now, of course, what's also going on is the stable coins that you use today, and these are now coins issued again by private entities. Now, there are different forms. I'm aware of that, different forms of stable coins. The most popular ones are the ones that basically tokenize commercial bank deposits. Tether, the most obvious one. Now, what you see here is what's happening is that you have the commercial banks that issue their own money. You have a credit risk in there. That's something that you do not have with the central bank. You might talk about inflationary risk, but commercial banks, just like stablecoin providers, they basically peg their money, the deposit that you have there, to the central bank money, to the fiat money, and they do it by guaranteeing you one-to-one convertibility. That's how they peg, that's how they keep their money stable, by pegging it to the central bank money. Now, if you have a private stablecoin issuer, you have now basically a second credit risk that comes in. So you have the credit risk of the commercial bank. The commercial bank could go bankrupt, but also the issuer of the stablecoin could go bankrupt. So basically you have now two layers of credit risk, which is riskier than just the commercial bank deposit alone. Now, of course, one obvious way where I guess a lot of banks will go in the future is that they just do it themselves. They offer this token themselves, so you only have one credit risk. You have the credit risk of the commercial bank. Another way to do it, of course, is that the banks that have a deposit with us, they could also just tokenize the deposit they have with us. For instance, Signum, Marcus will talk later, they do it for their customers. SDX, that will start trading this next month, that's also what they do as a financial market, as a regulated financial market infrastructure provider. They have an account with us. They will issue a stablecoin for payment on their DLT. That is a tokenized deposit that they have with us. Now, some people, and including the IMF, have been calling this type of stablecoin a synthetic CBDC. Don't, because that's not what it is. A CBDC would be a liability of the central bank. This type of stablecoin is still a liability of the issuing organization. So in the case of SDX, it's a liability of SDX. You still have this credit risk in there. If SDX or the issuer of that stablecoin would go bankrupt. Now these are the forms of basically tokenized or tokenization of already existing money exist today, or at least are talked about today. I guess that's the most popular forms. And so the first lesson is yes, they can coexist, but you have to make sure that that the customers want them. So you have to offer different type of services with the stablecoins. Now the next part is about regulation. So basically what I could imagine is that the stablecoin providers, that the commercial bank themselves will just start issuing stablecoins. As I said before, you will reduce credit risk, or that stablecoin providers will become regulated banks, basically. Then you also take that layer of credit risk out. Now, that has a lot to do with the stabilization mechanism, and I think in Switzerland, FINMA has done a great job regulating the emerging crypto financial sector, and there the rule usually is if you do something, the same risk, same rules, if you do something similar that other financial institutions or services do, you get the same regulation. So if you think about asset-backed stablecoins, the most popular one like Tether, what they basically do is, just like commercial banks, they make their stablecoins redeemable at the fixed price or this convertibility. That's how they keep the stability, that's how they keep their coin stable. And to do that, to be redeemable or convertible, of course, you have to hold reserves. Most of the stablecoins started with full reserves, just like commercial banks. And at one point, they realized that the probability that everyone at the same time shows up and wants to redeem or convert their stablecoin again into the underlying asset is very low, so that they move usually to a fractional reserve system. It's much more profitable. That's what's happening with Tether, that's what's happening with other stablecoins, that's what historically happened with commercial banks. And that's where you see usually comes the need in for regulation, because accidents can happen. Customers are not happy. It's not just that the state wants regulation. A lot of times it's the customers who do not want to lose money, and they ask for regulation. So that's one thing. If you have an asset-backed stablecoins redeemable, you will somehow go into the direction of a regulation similar to commercial bank or bank regulation. Now, of course, you could say, let's forget about this convertibility, make it not redeemable, but basically the coin would be some kind of an ownership share of the underlying assets. And that's, of course, that's when you go into the direction of mutual funds, closed-end probably mutual funds, or exchange-traded funds. In that case, the stablecoin will reflect the underlying value of the assets, but it doesn't necessarily have to track it very closely. You know, you can have a divergence of prices. Depends whether you on the arbitrage that's going on, but that usually works relatively well. That's something that at least DM, when I read the last white paper, intended to do. It looked more like an exchange-traded fund, where you also had authorized dealers who could then do the arbitrage issue and buy back these stablecoins. But then you go into the direction of the regulation of these financial vehicles. Of course, more interesting is if you do an algorithmic stablecoin where you have no underlying assets. And here you have, basically you could say, no intrinsic value. In the case of asset-backed stablecoins, where you have either convertibility or you have ownership share, then you have some kind of an intrinsic value. You can get something else for that. I'm aware there are also on-chain backed stablecoins. That's a little bit the more difficult case, but basically the most popular are the ones that are backed usually by commercial bank deposits. If you have an purely algorithmic stablecoins with no assets backing it, of course, then you have no intrinsic value. And I think these are the interesting things emerging. And that looks much more like a central bank than like a commercial bank. And here, usually, what you have as a price stabilization mechanism, you basically do algorithmic central bank policy. Just like a central bank, you either adjust the supply or you adjust interest rates, which basically in the end is the same. But these are the two instruments that you have to do. Monetary policy, that's how you keep it stable. Now, the interesting thing, of course, to me is that a lot of people talk about the inflation risk that they don't want to take. That's why they want to go into the crypto assets. Now, of course, stablecoins, even algorithmic stablecoins, I'm at least aware of, they all peg their value to the fiat currency. So you still have the same inflation risks that you have when you hold a commercial bank deposit or when you hold banknotes directly. So what would be interesting is to see a stablecoin that actually pegs, for instance, the consumer price index. Just like that's what central banks do. We basically try to have stability against the consumer price index. So that would be a real challenge, and that would be something where you could try to beat a central bank in terms of inflationary stability. Of course, you can also say, I don't really care about this stability towards a fiat currency. You can buy Ether, like we heard just before, or Bitcoin. Then you have this price volatility, but I guess that's interesting if you're an investor. But to use it as money, at least what we can see is that most people want to have the stability to consumer prices, and that's why you have so many stable coins emerge in this ecosystem. And let me stop here. Let me sum up. So can they coexist? Yes, they can, but probably you have to offer different services than what central banks do. That is probably not that difficult because central banks, if they will issue CBDC, they will basically focus on something very basic. They will focus on security, on stability. They will not be very innovative, just like today. So there is room for innovative private issuer. And so the coexistence is possible. But the second part, as I said, there will be regulation coming sooner or later, just because customers will demand that. And let me close here.